Welcome to Get Invested. I'm James.
And I'm Felix.
We hope you enjoyed our last video on why you should invest.
Our video today is going to be about what stocks and shares are and what the stock market is.
Let's look at what it actually means to own a share of a company. A share is simply a part of a company you can buy or sell on the stock market.
The stock market is like a marketplace where people go to offer or to buy stocks. The price of a share or stock fluctuates due to supply and demand.
The share price can increase but also decrease depending on how the company is performing. Many people think it's very risky to invest in the stock market, but this doesn't always have to be the case.
The idea behind the stock market is to help companies finance their business and for you and I to be able to benefit from their growth.
So imagine you have an idea and you want to create a business from it, but you don't have enough money to start it by yourself.
You could either borrow money or sell a part of the company.
So imagine we, James and Felix, wanted to start our own coffee business and would need €30,000 to get started. We only have €10,000 of our own, so we decide to offer pieces of our company to investors to raise their extra money.
We would sell shares of our company. Each share is worth a certain amount, based on what the company is worth. We would need to raise an extra €20,000 to start a business.
We decide to split the company into 30 shares. Each share is worth €1,000. Therefore, we would need to sell 20 shares to raise the money to get started. The remaining 10 shares we would buy ourselves.
Thankfully, a lot of our friends bought shares and we raised the money.
During the year, the company made a profit of €3,000, and therefore every share made €100 in profit.
The same principle applies to public traded companies on the stock market. So James, is a share of €1 actually cheaper than a share of €10?
Well, two things play a role in the price of a share. Firstly, the valuation of the company, and secondly, how many shares are actually on the stock market. For example, Company A can decide to have 10,000 shares worth €10 each on the market.
Company B may decide to offer 100,000 shares priced at €1. The valuation of both companies is €100,000, so don't be fooled by a cheaper looking stock price.
So the amount of shares is determined by the company, but what determines the valuation and therefore the price of a share?
Let's look into McDonald's as our example. As McDonald's grows and more people are eating in their restaurants, this will typically result in the share price to increase, as it will likely lead to higher profits. But if this growth was to slow down or decrease, the share price will likely drop.
However, the share price, more often than not, will be an indicator of future growth potential. So when you're looking to invest in a company, it's important to look at the future business strategy and not just how well they're doing today or how they have done in the past.
There's also other factors that can affect the share price, which are out of anyone's control. A couple of examples that cause uncertainty today include Brexit, the trade war between the US and China, or general economic factors.
Although it's almost impossible to time the market, be sure to have a good understanding of the company you want to invest in and be committed to the company's future strategy.
It's important to know that some companies also pay you a dividend when you are holding a share of their company. A dividend is basically a part of their earnings which the company is giving back to its owners.
This dividend can be paid on a regular basis, for example, quarterly, yearly, or as a one-time payment, although not all companies pay a dividend.
It really depends on the company and their strategy. Some need their money to invest in their growth, some want to pay a dividend to their investors.
And it's a nice way to be included in a company's success, and will give you some extra money in your pocket. Felix also wants to make one other thing clear.
So previously, we used the words stocks and shares with the same meaning, but there's actually a small difference. The word stocks is normally referred to an unspecific company, and shares indicate that you talk about a specific company.
Great. Now we've explained some fundamentals, we're going to look into the company Netflix, since most of you know and love this company. So currently, the share price is just over $360. They have roughly 436.6 million shares on the market, and this gives them a market valuation of just under $165 billion. Felix already owns shares of Netflix, and he wants to tell his story.
So I invested in this company 3 years ago since I saw the potential of it. I used the streaming service for years myself and loved it. I also saw more and more of my friends signing up. Therefore, I took the chance and bought shares of Netflix. The great part of owning a small piece of this company for me is that I actually pay myself by paying the subscription to Netflix.
And if you're using Netflix today, you're paying Felix indirectly as well.
The shares I bought in 2016 are now up 350%, and I'm delighted with the gains, obviously. If I would sell all my shares now, I would make a nice little profit. But I still believe in Netflix, so I will stay invested.
So please keep subscribing to make Felix happy.
Despite this being a real-life example, this is still a best-case scenario. Most companies would not grow their share price this fast, and worst case, you might even lose some money.
This is why you always have to do a little bit of research yourself to see if the company you want to invest in is the right company for you.
Netflix, for example, is still not making a profit as a company, and they are losing money every year. Their valuation is high because investors think that the company will turn a profit in the future and has a huge growth potential. Netflix shares are a great way to be a part of your favorite streaming service. Although the valuation might be quite high at the moment, it is definitely one to watch.
So why not think about a company you believe in or use every day? It might be Starbucks for your daily coffee, McDonald's for your burgers, or Apple for the iPhones. If you're an advocate of a product or service, why not get invested yourself?
If you enjoyed this video, please like, share, and subscribe to our channel.
Thanks for watching, and we'll see you in our next video when we talk about indexes. See you next time.